What's up, guys? Welcome back to the channel. In today's lesson, we'll be talking about flip zone. After today's lesson, you will know exactly how to approach the market once your supply and demand zones fail in the financial markets. Last week, I talked about my losses in the market, where I lost money trying to trade from supply and demand levels. Now, in today's lesson, I'm going to help you improve more in the financial markets by explaining the exact step you need to take once your supply and demand zones fail in the market. You can actually approach the same pair once it fails. Now, in trading, a supply and demand zone flip refers to market phenomenon where a previously established supply or demand reverse its role. So this is in a case where a supply and demand levels, they reverse their role in the market. That means the supply will either flip to a demand or a demand flipping to a supply. So this always occurs in the financial markets when we have change in the market sentiment, and sometimes it happens when there is a shift in supply and demand balance. So this is exactly what I'm going to explain in today's lesson: bearish and bullish flips in the market, how price can actually flip from a demand zone to a supply level, and how it can flip from a supply level to a demand level. Believe me, before the end of today's lesson, you're going to get a lot of value, and you can actually recover money as quick as possible once your supply or demand zones fails in the financial markets. Now, last week, when I talked about my losses, I lost about 3 trades last week. But as we may have it, this week, I've not lost any trade. I've actually had 5 trades that is running a profit currently, and I have one we just started into my zone, which is making it a total of 6 trades this week. So it's actually a good week for me. It's a very good week. And if you look at our free Telegram channel, you're going to see that we equally have good trade opportunities there. So this is the lesson where I talked about the losses, and this week I shared good trade opportunities, Euro GBP and AUDNZ. These are also trades from the VIP, which I decided to share to the free community. And if you look, the Euro GBP setup offered about 3%, but currently it has reversed to the downside. So if you secure the 3%, that's a good profit for you. And this on AUDNZD, which has now offered about 3% in the market. It's still running in profit. So I hope it gets to take profit. So if you have interest in joining this community, the link is in description and you can look to join us today. Now, if you're new to the channel, I'm Solomon Wisdom, and here is Born to Trade. On this channel, I teach about smart money concepts and how you can make money trading with smart money strategy. So if you're interested in concepts like this, consider subscribing to the channel and be part of this great community. So let's jump straight into what we have for today. We're going to be talking about flip zones. And I said we have a bearish flip and we have a bullish flip. Now, looking at the price action right here, what can you clearly see in the market? You can see that price react to the upside. We have the pullback, the reaction to the upside, and this is a break of structure. So this is actually a basic concept when you're looking at the market. When you have the break of the high, definitely you're going to have your demand zone in this case, because price broke above the high, forming a new higher high. This is your higher low right here, which prints this high right here. So this is your price range. Now, inside this price range, you're able to identify your demand zone, and you can see how price returned correctively back into your zone, sweeping liquidity underneath the low, and price mitigates our zone. So this is basic smart money concepts. Everyone understand up to this level. Now, at this point, you see price mitigates your level and you had a little reaction to the upside. So when we had this little reaction to the upside, you can agree with me that price was presenting good profits in the market. And finally, you see how price reacts massively to the downside and it breaks underneath your demand zone. This means that your demand zone has now failed to hold price. This is where you have to pay attention to what price is doing in the market. Why did this demand zone fail to hold price? This demand zone failed to hold price because big supply overpowered the demand. Okay, you see, when the institutions pushed back into the range, they feel their order inside this demand level, then supply entered the market. And you see, at this particular point, it takes a lot of order in the market to break levels in the market. So this demand level was not able to take the higher high. Instead, supply entered this market and pushed price lower, breaking underneath this low. Now, when we have that little reaction to the upside, you see, this little reaction to the upside before price push to the downside. And believe me, when price is pushing to the downside, it needs to come with a lot of momentum. Now, when the momentum kicks into the market, breaks underneath below, forming a change in the market direction, this means that supply has entered the level. Now, all you have to do is to select this level. Now, when it comes to selection of this level, because this is now your supply level in this case, when it comes to selection of the level, you have to take the whole of the range. But because of zone refinement, that's why you see me refining to this area. And you can agree with me that price came back to mitigate the supply. You see, price came back, mitigate the supply, and price reversed to the downside. So this is the quickest way to make money from the same pair once your demand level fails in this case, because you see, your demand level reacted and it failed. Now, what you have to do immediately is look to take advantage of the supply level and trade in continuation with the institution, because the institution sentiment has changed at this particular point. Now, a lot of people get it wrong when we talk about flip zones and breaker blocks. So breaker block is actually very different from flip zone. For a breaker block, price has to move with momentum, leaving imbalance inside this range. Not just leaving imbalance inside this range, but this level right here is actually your breaker level, okay? This level is your breaker block. But when we talk about flip zone has to be the first reaction before that expansion to the downside, which usually leaves an inefficiency, and as well making sure that we have an inducement. So this is what a flip zone looks, okay? This is a bearish flip where price flipped from a demand level to a supply level, where we look to trade to the downside. This is actually a bearish flip in this case. And this is exactly the same thing we have right here. Break of this high, price comes back to our demand level, because this is actually a very good demand level in this case. And you see price reacted to the upside, then fails and drops to the downside. And once price drops, all you have to do is to select your supply level in this case, expecting that price is going to come back, mitigate your level, and we're going to have the reaction to the downside, okay? Now we have a bullish flip right here, and bullish flip in this case is simply supply zone becomes a demand zone. And this is simply indicating a potential change in price. This means that price is going to move to the upside because a supply zone has now flipped to a demand level. Now, what do I mean from here? You see, at this point, price was bearish. You see, we have a nice break of structure to the downside. At this point, we were able to identify this a nice supply zone. Now, price came back for mitigation. We had little reaction. Then it fails to hold price. Once price reacts and breaks our supply level in this case, forming a shift in market structure, this is your whole demand level in this case. But because of zone refinement, that's why you see me refining to this particular level. And we see how price returns mitigate a level, and we have good reaction to the upside. So this is exactly the same thing we have here. Break, we have our supply level in this case. Price comes back. We have that reaction to the downside. Then price reacts to the upside. Our supply level fails. Then all we have to do is mark our zone. And remember, this is your whole supply level in this case, but we always have to refine our zone, so it's going to be profitable and favorable to us. This is where we look to select a point of interest and see price came back for mitigation. Not all flip zones are actually good to trade. Some flip zones can be traps when you look to approach them. How are we going to identify a high probability flip zone to trade? Because sometimes we look to trade flip zone, but some of them are actually traps in the market, and some has low probability of playing out. So with this same sketch right here, I'm going to help you understand the right flip zones to trade and the ones that has low probability of playing out. So let's start with this particular one right here. Now, at this point, you understand that price flips from demand to supply. So these are supply level right here. Now, what can we see which is going to increase the probability of this supply level playing out? That is our bearish flip. Okay, now at this point, what can you see? Price reacts massively to the downside. This is one of the confluence. Secondly, we have the break of the low, which forms a shift in structure right here. The major thing that is going to increase the probability of this flip level playing out is when we have an inducement area. Okay, once price builds liquidity above this zone, or price leaves an inducement area at this particular point, this increases the probability of this particular flip playing out. Okay, this is one of the confluence we have where price leaves an inducement area, then mitigates our zone and drops. This is a very good confluence. Now we have another one right here. This one has a very high probability of playing out. Okay, if you see this type, don't look to disregard this one because it has high probability of playing out. Now, in this case, price flips from a demand level to a supply level. Now, during the reaction, you can clearly see that price reacts, retrace to the downside. Then we have price closing above this particular high before we have that shift to the downside, which caused the shaped end of market structure. Now, at this particular point, what can you see? This is our supply level in this case. We've now identified our supply level. Now, what is going to increase the probability of this supply level playing out? At this particular point, you see price sweeps the liquidity above this particular high, okay? When a zone sweeps liquidity, this means that there is institutional involvement in the creation of that zone. Now, when price sweeps liquidity before the zone reverses to the downside, this means that institutions were involved in the creation of this particular zone we have right here. This zone that has been created at this point, there is institutional footprint at that area because price sweeps liquidity, then reverse to the downside, and it's moved with big candle. Now, one thing you have to understand is that liquidity is what moves the market. It happens that when price sweeps liquidity in the markets, institutional footprint has been identified in that particular area because institutions always moves from areas of liquidity, okay? And you need to understand draw on liquidity in the markets. Now, this is now another confluence that has improved the probability of this zone playing out. Another thing you have to understand is that as long as price sweeps liquidity reverse massively to the downside, even though it doesn't build any inducement area while it returns back to this zone, you can go ahead and approach it. This has high probability of playing out, okay? This is a very good one. So let's go over to a bullish flip. Now, in this case, you see price flips from supply to demand. Price reacts, moves to the upside, and came back to a demand zone for mitigation. Now, this one has low probability of playing out. You see this particular one, it has low probability of playing out. Why does it have low probability of playing out? In this particular case, you see price reverse to the downside without sweeping any liquidity. And at this point, you see price reverse massively to the upside and then returns back to this zone without building inducement area. So when you see this type, I advise you actually look to disregard this type. Instead, you can go ahead and trade from a zone down here. This one looks better and you're going to expect the mitigation of this zone. Then this particular area is going to serve as your inducement area, okay? So this particular one makes more sense when you see it on the price chart where price reverse to the downside, then reacts and returns without any liquidity. Because when there is no liquidity, there is no institutional involvement. Now, at this point, here is going to serve as your liquidity inducement area, and this low down here is going to serve as your supply level. This is going to be your correct flip in this case, okay? So look to disregard the ones that didn't sweep liquidity and doesn't have inducement while price returns back to your zone because this can actually serve as smart money trap. Now we have the last one right here, and this particular one has the highest probability of playing out, okay? Approach this particular one. So in this case, what can we see? We see that supply level in this case turns to a demand level, and you can see what price is doing in this case. At this point, price reverse maybe very far away from our zone before it reverse and breaks above a high. But one thing you have to understand in this particular example is that if you actually entered your trade, you must have hit your take profits if you do it based on risk reward before the reversal. But that's not where I want us to pay the most attention. Where I want us to pay the most attention in this case is that you see price sweeps liquidity underneath the low before the reversal, right? You can see that during the reaction to the downside, price now reverse to the upside, breaking above the high. And before it did that, you see we have the sweep of this low, and then we have our demand level in this case. Now, while price was returning back to our zone, you see price builds another inducement area. So you see, I love identifying areas of liquidity in the market. This improves the probability of any trading setup playing out. Now at this point, price mitigates our zone. Good reaction to the upside. So this is actually a very good one, and I hope this makes sense to you. Now let's see live chart examples, and I hope this is going to help you understand better. So we're going to start on gold. Now, if you watch the lesson where I lost money in the financial market, that was actually the last lesson before this particular one. you're going to agree with me that we're actually looking to trade from here on gold. I hope you can see that's where I was looking to trade from here. So let's play price forward and see how price reacts to this particular level while I was looking to trade from there. Okay, let's see what price did as I was trying to trade from that particular level. Now, playing price forward, you see price was now returning back to our zone, and what can you see? We had good reaction. I hope you can see that at first price respects our zone, good reaction to the downside, then it moves above our high to give us a shift in the market structure. This means that the supply zone has now failed to respect the price, and now price reacts to the upside, breaking above this particular high. Now, this is actually where we're going to identify the flip in this case. Now, where is the flip in this case? If you're looking to identify your demand zone, this is going to be a zone right here. I hope you can clearly see this is a zone right here, and you can see the candle that actually moved above this particular zone moved with momentum. At first, you see price respect that zone, react to the downside, then moves with big candles to the upside. And you can agree with me that we have the confluence, which makes this a high probability one. If you look at this low, you can see that we have the sweep of this low. You can see price took the liquidity underneath this candle before price reversed to the upside. So we have a liquidity sweep. What else can you see? We have price imbalance right here. So this was one of the pairs which I and the VIP students looked at after the zone failed, but I don't think it's actually necessary trying to play the records. I might decide to play it, I might decide not to play. Well, okay, let me decide. I will play this particular record. So on gold, we look to trade from the supply level. Price reacted a little bit, then continues to the upside. Now, if you're looking for area to trade from on gold, I guess this is a very good area because that little reaction to the downside formed the pivot that created this zone, and this is now a flip zone. Okay, it's now a flip zone. So if you look at the 2 hours time frame, this is where we have some pricing efficiency. So playing this record doesn't really make sense to me anymore because I don't think I have any more thing to prove in the markets. I don't have anything to prove. What I show you is what is happening in the markets. I use recent price actions. Anytime you see me teach on the price charts, I don't like manufacturing charts. So price this inefficiency, sweeps liquidity underneath the low, and you see this is a demand level in this case. What you have to do is just to enter your position. Now, in this case, since price has now swept liquidity underneath the low and reacted to the upside, whether it builds liquidity while returning back to our zone or not, it doesn't really matter anymore because price has now swept liquidity before it reversed. But if it builds liquidity, then it increases the probability of this playing out, and it's actually the one that has the highest probability of playing out. So let's see what price do. Now price came back, mitigate our zone, react, and it came back once more for another mitigation. And if you look at it from a lower time frame, you can see that this may actually serve as maybe confirmation entry if you're actually looking at that. Then I think price came back once more. You see price came back once more to sweep these 2 lows. Then this is where institutions step in. That's why I said that the institutions will always seek for liquidity. So we have something like relative equal lows inside our zone. Then you see price coming back once more to sweep that before price blasts to the upside. So I hope you can clearly see that. And this is the current price action. This is where price is at currently. So this is how you can actually take advantage of your zones when it fails. So this was at supply level. It failed to hold price. Then at this point, I and my students, we look to trade from this particular area. This was actually part of what we looked at during our meeting, I think on Sunday. So it's actually a very good trade opportunity, and you see how you take advantage of flip zones, okay? Flipping from a supply level to a demand level. Now, let's see more examples. The SZD card setup, which failed last week, also presented a flip zone actually, but it's not actually part of the examples we have for today. So let's look at CHFJPY. So this is CHFJPY, this is on the 4 hours time frame. So if you look at this particular area, you can see that price was bearish, pushing to the downside. Now, at this point, if you're asked to identify your zone in this case, this is going to be your supply level. And this is actually another supply level example. In this case, this is a very good supply level. And all you have to do at this point is just to wait for price because you're actually looking to sell to the downside. price comes, mitigates your zone, and you have little reaction to the downside. Now, your bias in this case is you're actually looking at price and you're expecting that price is going to drop to the downside. Now, playing price forward, you see price reacts above your zone. Okay, I hope you can see that after price reverse to the downside, giving some good reaction, because this is what I explained. Once you see that price has now mitigated your zone, reverse to the downside, giving good reaction, then fails and offering a shift in structure at this point. Because another important thing I said is that it has to be an institutional candle, that is candle with large body. Now, this is where you look to take advantage of what price is presenting in the markets. Now, if you look at this particular point, what are the confluence that is going to increase the probability of this setup playing out? At first, you see, we have that liquidity sweep. Price takes the liquidity underneath this particular low, which has now increased the probability of this playing out. And at this point, all you have to do is to select your zone. In this case, this is a very good point of interest. And I think price built some inducement area right here. You see, we have equal lows at this particular point. Then price comes back for mitigation. Now, playing price forward, what can you see? Price moves away from there. Okay, you see, price moves away from demand level reacting to the upside, but currently we've had price returning back to that level. And after that, price has now continued to the upside. Okay, so this is actually how you can take advantage of this particular trade opportunity when you see it in the market. Okay, this is how you can take advantage of these levels once price comes back to it. So this is actually the current price action. I think I should show you more example, which is actually going to help you understand this better. I have a lot of examples of flip zones. Once your demand and supply zones fail, you can go ahead and take advantage of what has happened in the market, then get good results in the market. So let's look at the next example. So let me quickly introduce our mentorship. This is our advanced smart money mentorship, which is currently running. Okay, this mentorship is running currently. This is the 0.2 mentorship. This is an advanced smart money concept. And in this mentorship, we'll be teaching you advanced smart money course, how to approach the market using smart money concept. So if you enroll for this mentorship, you're going to have access to our course, our advanced smart money course. You're going to be part of our weekly chart breakdown. You're going to be part of our VIP support group, even our discussion group. You're going to be part of that. You're going to have access to our premium possible setups. That's our trade opportunities. You're going to be part of our weekly Zoom meetings. Just like I said, after a Zoom meeting on Sunday, finding trade opportunities, we've not lost any single trade. Okay, we've not lost any trade this week. So you can be part of that, but have it in mind that we didn't lose trade this week does not mean we don't lose trades. Last week, personally, I didn't win any trade in the market. But this week, as you can have it, we will be making good profits in the market without losing any trade. So you can look to enroll for this mentorship, which costs about $216. And this is actually a lifetime access. You're going to have access to our VIP community for lifetime, and you're going to have access to our course for lifetime. So if you're interested in enrolling for this mentorship, you can go ahead and do that. You can look to use the payment methods we have right here. And these are some of the reviews from those who enrolled for the first batch of our mentorship. So the second batch is already running. You can look to enroll today and we understand exactly how the institutions trade. So this Euro AUD, this on the 2 hours time frame, and this is actually a very good example if you're actually looking at this. So what can we see right here? Price is bullish. Price has been trending to the upside. You can clearly see that price has been bullish, trending to the upside. So at this point, if you're actually looking to select your point of interest, where is going to be your point of interest? This is a very, very good point of interest if you want to trade from here. And a lot of people might actually say that, why didn't you select the lower one? You can already see that price has now rebalanced the inefficiency we have at this particular point. So selecting these points of interest is actually the best thing to do in this particular area. Now, anyone that enters trade right here, we have their stop loss underneath the low, and they're actually going to place their profit targets. A lot of people usually go for the external range liquidity. So let's assume that you're actually going for the external range liquidity in this particular case. Now, plain price forward to see. Now, price starts to give you good reactions in the market. And after that, what can you see? Price now takes you out of the market. You see, price just gave good reaction at first. This reaction offered how many percent in the market? This offered about 2%. And after that, you see price returns back to the downside. If you have your stop loss underneath the low, you can clearly see that price has now swept the liquidity underneath this particular low. So this zone has now failed to hold price. So this is where the flip comes into play. Okay. Now, what you have to do at this particular point is to select your point of interest, because you can agree with me that this was a reaction before the demand failed to hold price. Now we're going to have a demand to supply flip, because the demand has now failed. Then we're going to look to trade from our supply level. Now, where is the supply zone? This is the supply zone you're going to trade from. A very good one, and it meets the criteria. And this one is actually the one that has the highest probability of playing out, because we have a very obvious liquidity sweep at this particular point. Price sweeps the liquidity above the particular high. Then price has built an inducement area. Not just building inducement area, we have price inefficiencies at this particular point. So this has the highest probability of playing out, and it's actually a very good setup. So if you're looking to trade from this level, can enter your sell position at this area, your stop loss above the high. You can decide to add few pips, then you can go ahead and project your targets. This is actually about 6% if you're looking to go for this low. Now, this is the whole trade opportunity. This is very, very simple. Trading flip zones, okay? Trading flip zones, this is a very good trade opportunity. Now, let's see how price reacts. Now, price comes back, tags you in. You actually got involved from this area. This is a very good one. Price tags you in, and it's currently reacting to the downside. Let's see how far price can go. Now, you see, price has now offered about how many percent? This is about 5% in the market. And let's see if price could get to the 6%. And finally, price hits those 6%, and it's currently dropping to the downside. Now, one thing I said about this particular trade opportunity is that it shows change in institutional sentiment, because you can agree with me that the institutional sentiment has changed at this particular point and price is bearish. Now, imagine holding from there to this particular point. This has offered about 8% in the market. This is a very good trade opportunity if you're struggling to make profit from your supply and demand levels. This is where you can decide to change how you look at the market. You can now decide to trade the flips, okay? If you fail to make money from the real supply and demand levels, this is where you can decide to trade flip zones. Flip zones can actually make you good money in the financial markets. Just wait for price. Once the supply and demand zone fails, you can go ahead and trade the flip. I don't know if I should show one more example. Thanks very much for watching today's lesson. I actually wanted to show one more example before I end the lesson, but let's stop here, okay? All you have to do right now is to go back to the price charts and backtest every single thing you see me explain in today's lesson.